Well, let me welcome you today. This is one class in a series of a number of classes I've taught over the years, and I won't list them all for you, but I've taught classes on subjects like landlording. We call it positive landlording. I taught a class on buying properties from owners and lenders in distress. I taught a class on lease options. I've taught, I think, 9 classes altogether, all on very specific topics, and they're all one-day classes, and we've recorded them like we're recording this class today. And we go into real depth into one topic. So I encourage you, if this is the first class you've taken or the first class you've heard, to study other material. This material actually builds on other material and assumes that you know what a house is. It assumes that you know how to buy a house below the market and finance it and manage it. And if you don't know those things, if you don't have those skills, you need to acquire those skills before you try to invest with other people. Probably the worst thing you can do is take somebody else's money and lose it. That's going to hurt your reputation. It's going to make you feel bad. It's not going to make you any money. So you need to develop some skills so you have these skills before you start soliciting money from other people. I will tell you that when I first started in this business, I had no money. I started right out of college, and when I needed money for a down payment, I would go out and find it from somebody in this town. And we're going to talk specifically about how to identify those people, how to talk them out of their money, how to structure deals that are good for you and for them. Because if you can do that, if you put together deals where everybody makes money, and I'm happy to say, we've had to wait a while for some of these deals to work, but I'm happy to say that if you're patient and you hold on to these deals for a while, everybody does make money and everybody feels good about it, and that's the best scenario, of course, because now they'll tell their friends and you have more money. So we're going to talk today specifically about how to put together deals that are good for you and good for everybody else. Okay, let's get to page 1 then. You might ask yourself the question, why would you want to invest with somebody else, or why would you want to, on either side of that? And you should know we're going to talk about both sides of the equation all the way through today. I've taken either side. I both asked other people for money and invested their money, either borrowing it or doing joint ventures. And I'm going to avoid to use the word partnership today for several reasons. We'll talk a little bit about why not to be partners, but a partnership is not a word that I suggest that you use, or joint venture, another bad word to use when you invest money with other people, because if you define those words, they're used typically to operate a business. And one thing you want to retain if you're going to invest money with other people's money, invest with other people, is you want to retain control. How many people are control freaks in this room? One reason you're in real estate, you're a control freak. You want to be in charge of a real estate investment. The worst thing you can have is a committee making decisions. And if you have 3 or 4 people involved, it can be a disaster. Deciding when to buy, when to sell, when to finance, when to rent it, who to rent it to, those decisions are best made by somebody who understands the business, who can make those decisions in a hurry. So you don't want to set up a situation where you have authority shared by a number of people. You want to keep this deal as simple as possible. And if somebody else gives you their money or loans you their money or invests with you, you want to, first of all, be in charge. You want to put the deal together so you know what's going to work. And then you want to stay in charge of this so you make it work. Because if it either works or it doesn't, you should take full responsibility for that. And if you look at it that way, I think you'll see that it's a lot more satisfying from your standpoint. We made quite a transition over the last 30 years. I started in the business here right in this town 30 years ago. And I started off trying to make $1 million in a hurry. Anybody ever do that? So I made this transition from big deals to small deals. And I did it a lot faster than 30 years. I did it in the first couple years. I found that when I was investing in bigger deals, I was dealing with some of the smartest people in this town. Is that a good idea when you're getting started? I learned lessons I didn't want to learn. I won't mention people's names, but I went up against some of the sharpest lawyers in this town and tried to buy things from them. It was bad strategy. These people have been doing it for 30 or 40 years. They saw me coming. They had fun with me, and they made a lot of money off of me. So I made this. I figured out, it was a humbling experience, but I figured out pretty quickly that wasn't the way to make money. I didn't need to be negotiating against people who had 20 or 30 years experience, who had a lot of money, who had a lot of education I didn't have. I thought I was the smartest guy in town when I first got here because I had both a degree from University of Florida and a real estate broker's license. I said, what else is there to know? I had it all. But I learned pretty quick. I didn't know much. I just thought I knew something. So I made this transition from big deals to little deals over a period of time. And I found that when I was negotiating with the smaller deals, a couple of good things happened. Number one, at least we were on equal terms. You know, the people I was dealing with weren't much smarter than I was. It kind of leveled the playing field. And I found a lot more deals. One thing you notice pretty fast if you're trying to make a lot of money on one deal is there's typically competition. There are a lot of investors. Is there any shortage of money in the world? There is no shortage of money in the world, and there's a ton of investors out there. And if you have a really good deal on something big, a mobile home park or a little shopping center, there'll be a lot of competition for that. There'll be several people trying to buy that at all times. And one thing you don't want in this business is competition. You know, you don't want to be going head to head against people trying to buy things, and there's two other people trying to buy the same property, because you have a hard time getting a good price, and you have a hard time getting good terms. So I tend to look for deals where there's a lot less competition. And you'll hear me talk about houses a lot today because I like houses. And I like houses for several reasons, and we're going to cover that in a second. But one of the reasons I like houses that I buy is there's typically less competition. You know, there's not 4 or 5 of us trying to buy the same house. I found it, and nobody else knows about it, so I can make a pretty good deal on that. And that's a key to investing with others. You want to make sure that when you make a deal, it's a good deal. If you go out and take a bad deal and split it up 2 or 3 ways, that doesn't make it a good deal, does it? Paying retail for a property and bringing 3 partners in doesn't make it a good deal. And there I use that partner word again. I hate to use that because I don't want you to think partners when we do things. And so I'll try to reform my language and help you reform your thinking. The other transition we've made, and it's been a more subtle transition over the years, is from buying houses that produced a lot of cash flow to buying houses that produced a lot of capital gains. I want you to think about that for a second. Buying houses that produced a lot of cash flow, and that's where we started. When I first started in this business, I had no income, I had no money in the bank. So when I bought something, what was the primary thought in my mind? Producing cash flow. I wasn't going to buy something that lost $300 a month to give me tax shelter. That wouldn't be a good deal. I didn't need tax shelter. I needed money. So everything we bought had to make a little bit of money in the beginning. And so we bought things specifically for cash flow. Well, if you buy real estate, and particularly houses for cash flow, what kind of houses do you buy? Less expensive houses. Less expensive houses. And you can still do that today. And can these houses be bought with low down payments? Sure they can. There's a lot of houses out there, especially in rougher neighborhoods, houses that need work, and if you want to buy one, I just happen to have one. I'll make you a deal on. In fact, I sold it yesterday, and I sold this house for $100 down. That sounds like a pretty good down payment, right? You haven't seen the house, though. This house, and you can ask Brian about this house at a break. This house needs a little touching up, as they'd say. Windows would be a good start. But houses in rough neighborhoods that are run down can be bought for very low down payments because the people who own them don't want them anymore, and they'll make you a good deal. And those houses do have cash flow. I mean, I could rent this house and make money on a cash flow standpoint, but you give up something. What's the first thing you notice about houses that have a lot of cash flow? They're more work. They're more work. The people that gave me $100 down, you know why they gave me $100 down? That's all they had. That's all they had. We talked to them, and they make money, but she's bringing in $300 more on Monday and then paying $250 a week, for 3 months. But that's how they have to pay because they don't have money. So that means you have a weekly rental going in effect. And these people want to buy the house, and we're hoping to convert them to buyers, using that money as a down payment. But it's a lot more work because you have a lot more going on. You have a lot more to deal with there. And if you're just renting these houses, now you're dealing with people that have troubles on a regular basis, so it takes a lot more of your time. And if you look at the numbers, let's say you want to control $1 million worth of real estate. If you were buying houses that were worth $50,000 a piece, and that's what I sold this house for, $50,000, how many houses would you need? You need 20 houses. You need 20 houses. And that's a lot of moving parts, isn't it? 20 is more than a lot of people want at any one time. So let's move down the other end of the spectrum. If you're buying a house just for capital gains, and the reason I'm talking about this is because when you're dealing with investors, some investors are going to want cash flow. Other investors are going to want capital gains. What's the difference in the tax rate between just straight rental income or interest income here at the cash flow side and capital gains rate? What's the maximum capital gains rate? 20%, I think, isn't it? 20% today. Now, this may change over time, but it's 20%. What's the maximum rate if you have interest income or rents? If you earn $1 million a year in interest, what will your highest marginal rate be? It's going to be in the high 30s, isn't it? high 30s, almost 40%. So just for the sake of discussion, let's just call it 40%. What's the relationship between those two numbers? One's twice as high, isn't it? So if you have an investor who has a lot of money and who has a lot of income, if you can structure a deal with that investor so that you can give them their profit in capital gain income instead of interest or rents, you can give them twice as much money, okay, or they'll pay half as much in taxes. So you can make a better deal if you're a little smart in how you structure these things. So if you're just paying somebody interest and they're already in a high tax bracket, if you pay somebody 20% interest and they're in a 40% tax bracket, how much do they get to keep? About 12%, right? It takes a chunk out of that gross interest. So you want to think through this as you deal with investors, and you want to think through this if you are an investor. You know, if you are loaning people money and you're in a 30 or 40% tax bracket, you want to think, how can I get this money back as capital gains? And I'll show you several ways to do that here as we go through today. So over here on the capital gain side, if we buy houses that have the most capital gains, what price range are we going to be talking about? We won't be talking about $50,000 houses, will we? Talking about more expensive houses. What's the most expensive house anybody in here has bought for an investment in the last couple of years? Anybody have one over 100,000? Over 200,000? Almost? Well, you almost. You're trying to buy one for 300,000, weren't you? Three and a quarter. Okay. We bought several houses in the $200,000 to $300,000 range. Do you have as much cash flow when you buy a house in that range? No. What's the major advantage? Well, there's not much competition. That's a good answer. But the major advantage is this capital gain that you get. The capital gain. We've been trying to buy houses on the water, and we bought a number of them on the water since about the first one I bought on the water was '73, and I still have it. The waterfront houses do what? They appreciate more. Your cash flow is miserable. Your cash flow is miserable. But it's a good trade-off if you're in it for the long run. That house I bought in 1973 and paid $32,000 for on the water is probably worth $350,000 today. Now the rent's only $1,200 a month. Okay? So if you look at the $350 and the $1,200 a month, you say that's a miserable deal, isn't it? That's a miserable deal. Can you go ahead?
Yes, all your most expensive houses, how do you structure it from having
You just say it's simple. The question is, how do you structure this house from having negative cash flow? You just pay cash for it. Okay? Now you have $1,200 a month positive cash flow, don't you? See? That's before taxes and interest. Yeah. This class is really a simple class. We don't do anything fancy in this class. Now, where you have negative cash flow on a $350,000 house is when you try to borrow a lot of money against it. Okay? So you should ask yourself the question, if you want to buy a $350,000 house, how much money can I borrow against this house and pay it back with $1,200 a month? Or actually less than $1,200, because that's the gross rent. We have to pay taxes and insurance and maintenance out of that $1,200. I'll probably end up with maybe $900 a month or $800 a month net rent. And we'll deal with those numbers today. But let me ask you, how much can you borrow and pay back with $800 a month? Well, it depends on the interest rate, doesn't it? If you're borrowing it at 18%, it's not much. If you're borrowing it at 6%, it's a lot better. Brian, what was the interest rate you got on that non-owner occupied loan? 6 1/8, 1 point, right? 30-year fixed rate. That's an investor loan today. Who's got a calculator right now and knows how to use one? It's a two-part question. Okay? How much can I borrow at 6 1/8 interest, 6.12% interest, 30 years, and have payments of $900 a month? Somebody answer that question for me. $148,000. So I can buy this $350,000 house that rents for $1,200 a month and owe $148, just call $150,000 on it. Does that mean I have to put $200,000 down? If I paid retail, I put $200,000 down. What's one other advantage of buying a more expensive house? You can buy it further below the market, can't you? You can buy it further below the market. How far can I buy this $50,000 house below the market? If I buy it for zero, how much did I get below the market? 50. If somebody just gives it to me, I'm 50,000 below the market, right? That's as good as it's going to get, isn't it? And it's not going to get that good very often. Generally, you have to pay something for a $50,000 house. But over here with a $350,000 house, how far below the market can I buy that house? More potential, isn't there? Now, I'm not going to tell you it's easy, but you could buy that house $50,000 below the market. You might be able to buy that house $100,000 below the market or $150,000 below the market. But here's the math you have to do. If you're going to buy this house for an investment and you know you have this much gross income, $1,200 a month, and you have $900 a month net income, and you know if you can get that loan, would that be a fairly safe loan if you could borrow $148,000 against a house that's really worth $350,000? Do you think you could get that loan? Some banker would make you that loan? Sure they would, because that's a real safe loan. That's a 50% loan, isn't it? So the question is, how much do you have to pay for the house, and how much money do you have? How much money do you have? If you could bring an investor in and buy this house, this $350,000 house, for $250,000 and put $100,000 down, it would work, wouldn't it? And that would be a good deal, wouldn't it? Because now you've bought something below the market. You put enough down payment. We're going to pull all this together for you, but the only reason to bring an investor into the deal is so they bring enough cash into the deal to drive the price down and allow you to get really good financing so that the deal makes sense. You wouldn't let an investor in a deal with nothing down. That wouldn't make any sense. The only reason to let an investor into a deal, if you found a deal, is to have them bring enough cash into the deal to drive the price down, get a good deal on the price, and then have enough financing, get a really good deal on the financing, because it all goes together, doesn't it? If you get a good deal on the financing, a good deal on the price, you buy it below the market, and you put a chunk down, there's not much risk to the financing then. You're only borrowing 50 or 60 or 70%, and if you can get the loan down that low, you can get better interest rates. So it all goes together, and you'll see it all pulled together as we get there. But this is a transition. This is not where you start. You start off buying $350,000 houses? I don't think so. Now, I got lucky on that house. When I bought that house back for $32,000 in 1973, was that a lot of money in 73? What did a brand new car cost in 1973? $3,500. So this is like 10 cars. 10 cars. What's a brand new car cost today? $30,000, right? Still 10 cars. Isn't that right? It's a relative thing, isn't it? You go out and buy a new Toyota, you can spend $30,000, can't you? And if you get one with four-wheel drive, you spend more than that. You get one of those big cars, you spend more than that. So it's still about a 10-car deal. But when I bought this house, I put 20% down. Okay, and the owner financed the balance at 7% for 20 years for me. That's what made that deal work then. And where did I get the $7,000 down? Did I have $7,000 in 1973? Everybody go like this. No, I didn't have that. That was a lot of money, and that was a full year's income in 1973. Put it in perspective for you, Daniel. You may not believe this, but that was a whole year's income in 1973. You could live well on $7,000. Think of it as 2 cars. That was 2 cars in 1973. Would be the equivalent of $60,000 today income. And I didn't have that $60,000, so I went out and found an investor who put the $7,000 up, and we bought that house. First deal. Okay, but I wouldn't start there. And I got lucky on that house. I'll admit it. But I wouldn't start there if I were you, Daniel, or somebody just getting started. You have to start over here. You start closer to this end, but then when you figure this out and you start making connections and you start finding people that will invest with you, as soon as you can, you want to move toward this end of the spectrum. And this wasn't the first property I bought. I probably bought 20 properties by here, but it was the first house I bought that I still own. That was the first keeper that I still have. Now, we're going to talk about a couple different ways to invest with people, and one way is going to be having people put up money and owning things together, okay? And when you own things together, then both people can participate by the type of income that's generated, be it capital gains or rental income. And we're also talking about having the investor just loan you money. If you have a choice, would you rather just borrow money from somebody or give them half the profit? I hear both answers. Isn't that interesting? When you give somebody half the profit, how is that helping you? What's the benefit to you when you don't borrow money from somebody, you let them share in the profit you make? If you don't make any profit, how much do they get? Nothing, right? If you borrow some money from them, you have to pay it back, don't you? So they're going to make a profit when you borrow. So it's a different type of deal, a different mindset. Sometimes it's a different person altogether. But I've made different deals with the same person. And I'll explain that to you as we go on. But as many of my investors, I do both deals with. I will borrow money from them sometimes, and then I'll give them some of the profit sometimes. And that's good strategy, I think. because I give them some of the profits on the deals that aren't just gangbusters. You know, if I can buy a $350,000 house for $250,000, I'm going to try to hold on to that one all by myself, because that's a really good deal. I'm going to try not to give half the profits away on that one. I would rather borrow the $100,000 down payment if I can and can make some sense out of it than give half that $100,000 away. Okay. On the other hand, if I can buy something that takes a big down payment and the major benefit is going to be growth, long-term growth, I might give half the profits away because it may or may not go up. Anybody ever bought something you thought was going to go up and it didn't? Yeah. And in this town, you know, in a good town, in a good part of the world, because they don't always go up. Sometimes you guess wrong. So those are the ones you want to invest with others. As my wife puts it, she says, now I want to be your partner on the good deals, find another partner on the bad deals. I mean, she has this all figured out. She can look at it pretty simply. You don't need an investor on every deal, but I went back and counted. About half the properties I bought over the last 30 years I bought with investors. About half. And a lot of them in the beginning. Almost all of them in the beginning. Because I needed the money. And it was okay. I've got a friend, Jack Miller, and some of you know Jack. It aggravates Jack to give half of anything away. You know, it aggravates him to give anything away, but especially half the profit on something, because it's way too much sometimes. If you figure out the percentage that the investor is making, it's not 8 or 9%, it's generally 15 or 20%. So the investor is doing very, very well on these deals. And what I've never been able to get Jack to understand is there's deals you can't buy any other way. You know, if it's a house that I can buy for a very low down payment, I'm not going to call an investor up if I can buy a house for $2,000 or $3,000 down. I'm going to buy that one myself. But if it's a house that takes $50,000 or $100,000 to buy, and I don't have that money, and I can get that money from an investor and still make an additional $30,000 or $40,000 on my side, that's money I wouldn't make if I didn't use that money. It's sort of like using bank money. I mean, there's sometimes you just have to go to the bank and borrow money, and if you didn't, you wouldn't be able to make the deal. I don't like going to the bank to borrow money, and I've never gone to a bank to borrow money to buy a house, not in 30 years, because it generally takes too long. By the time I go to the bank and make an application and borrow the money, the deal is gone. So you have to have some other way to buy houses if you want to buy at wholesale prices. But once you get into the business, you'll find that there's investors who will loan you money, and you can come up with bank lines of credit. How many people have a line of credit at the bank? You should have one. If you don't have one, go down and start now. Interest rates are low. Credit's still pretty loose. And you know, even if you don't have much experience, you can go down and borrow 5 or 10 or 20 or 30. They don't like to loan you just $1,000 or $2,000. They want to loan you enough money where they're going to make some interest. But establish some kind of line of credit. While credit is loose, it's a good time to go down and establish as much credit as you can. Because what might happen over the next 10 years? The economy could cycle. Things could maybe become very hard to borrow money. And if you have established credit, you still may be able to borrow some money where other people can't. And when nobody can borrow money, what happens to real estate prices? They get better. You make better deals. Because if nobody can borrow, your competition disappears. Your competition disappears. So you want to be in the business when nobody else can borrow money. I invest in houses because they're a very conservative investment. But I take a very aggressive stance when I invest. And I typically buy things with very high leverage. When you're buying a property to hold on to for 20 years or 30 years, how much do you want to put down? Nothing, right? You really want to buy something with nothing down. I had a student take my class, Making the Big on Little Deals, years ago. His name was Bob Allen. He took the class twice in a row, and he wrote a book called Nothing Down. And that's an excellent strategy. You should go back and read that book if you haven't read it. The key is not just to buy something with nothing down, though, is it? It's to buy something with nothing down that's a safe investment, because this is high leverage. Is nothing down high leverage? That's as high as it gets, isn't it? Actually, you can borrow more than that, can't you? There are people that borrow 125% when they buy. That's crazy. But you have to buy something that's not going to do this. What kind of real estate does that? Goes up and down in price radically. What kind of real estate might go from $500 a unit to $1,000 a unit, and then back to $600 a unit, and back to $2,000 a unit, back to $800 a unit? What does that look like to you? It looks like land to me. Now, if it's commercial land, that may be a square foot cost. If it's a farmland someplace, that may be an acre cost. But you find something that produces no income at all, okay? That's really speculative in nature, and the only way you're ever going to make any money is to sell it for more than you paid for it. There's no depreciation. There's no income. Does land go up and down in value? go like this. It does. It goes up and down in value. And commercial land does this. I mean, commercial land is really hot when the commercial market's hot, but when the commercial market is not hot, you can't give the stuff away. Commercial buildings, office buildings, strip centers go up and down, and it may not be quite this radical, but they go up and down in price. They become very hard to sell at certain times of the cycle. So if you get stuck with those things at the wrong kind of cycle and you need to get rid of them, you have to sell them really, really cheap. One reason I stay in the house business is because house prices tend to look more like this. They're not nearly as exciting. They don't have the upside potential. Now, if you graft waterfront houses, maybe you'll see more of an upside, up and down type mark. Do rich people ever get in trouble? Sure they do. And the people that own waterfront houses, will there be foreclosures on some waterfront houses in this town, one of the best towns in the country? There will be. There'll be people who get in trouble. So there may be somebody that pays $3 million for a waterfront house, that ends up losing it, and it'll sell for $2 million, same house. Well, that's a pretty good swing, isn't it? $3 million to $2 million. I'm not suggesting you go there, but you will see that kind of thing. If you take kind of more average houses in average neighborhoods, you'll find that prices tend to be much more stable. And what's the reason for that? Demand. And how much do people borrow? And let's just say this is a $150,000 house. How much do people borrow when they buy that $150,000 house? What percentage of the total amount that most new home buyers borrow? Isn't it a lot? Isn't it a lot? Isn't it usual they might have a $130,000 or even bigger than $130,000 loan? Well, if you have a $130,000 loan, you put 20 down. What are you unlikely to do? Sell it for less than $130,000, right? Now, some people have to. Some people do get foreclosed on, they get divorced, they have tragedy in their life, and these houses do sell for less than $130,000, but the great majority of them don't. Most of them stay. That kind of establishes that new floor, and they keep creeping up over time. Now, is it true that there'll be periods of time where they don't go up much? The 80s was like that around here. We had about a decade where not much happened. And houses were very, very flat. And I'm very aware of that because I bought a lot of houses in the early 80s, and by the early 90s, they hadn't done much. About 10 years later, they were basically worth about the same thing I paid for them in the early 80s, or the same price they were worth anyway. I hopefully bought them a little below the market. So you have to be sensitive to that and know that if you're going to do this, you have these long spans of maybe not much exciting happening, but you want to stay in a business until you get one of these, don't you? You want to stay in the business, what I just circled here on the board is this period where they're going to go up in price. You want to stay in business so you catch the 4 or 5 years where they go up in value. And that happens on a regular basis, and you get most of your appreciation during these hot markets in fairly short periods of time. And over the long run, if you look at this, if this is a period of 30 years, you'll find prices will consistently go up over that 30-year period of time. You don't want to be like the stock market guys and pick the day to buy and the day to sell. If you do that, you can get a tremendous rate of return on your money. But you say, if I make an average deal going in and an average deal going out, will I make a fair rate of return? And the answer is yes. You'll do very well, especially if you use what? Leverage. You use nothing down formula. You go in and buy things with very low down payments. Or, and that's what this class is all about, you get somebody else to put up the down payment. If you buy a house with $50,000 down, but it's not your $50,000, isn't that a lot like nothing down to you? It's a lot like nothing down to you. And by using that $50,000, what should you be able to do? Get a good price and get good terms. So you'll hear me say that over and over again, because that is the key to investing with other people, is to make sure you use their money to get that good price and the good terms. It'd be foolish to buy a house and not get that. The other thing you can do with houses when you buy is you can avoid personal liability. How many people have ever bought a house with any kind of owner financing? Okay. The rest of you should set this as a personal goal. Buy something with personal financing. In this state, and in almost every state, when you use what's called a purchase money mortgage, and a purchase money mortgage is when the seller finances the sale. So you go and you buy, and I'm just going to use a very expensive house as an example. Again, I'm not recommending you do this, but let's say you bought a $350,000 house, and you bought it for $300,000 with $20,000 down. Is that a lot of leverage on that house? Is that a scary loan, a $280,000 loan on a house that you thought was worth $350,000? Can you give me an example of terms on this $280,000 that would let you buy that and be happy? What interest rate could you afford to pay on $280,000 and cover it with, let's say, $1,200 a month? Anybody do that math for me? What's 1,200 times 12? 14,400. What's the relationship between $14,000 a year and $280,000? So just divide that out for me real quick. Got those calculators working? It's almost exactly 20. So it's just about 5%, isn't it? Anybody see that? If we took 5%, wouldn't that be awful close? 5% of $280,000 would be $14,000, wouldn't it? So if we could borrow that money at 5% interest only for 20 years, would you buy that house? Who would buy that house, 5% interest only 20 years? The rest of your arms not working? This is a really good deal, folks. You're buying a $350,000 house for $300,000 with $20,000 down, 5% interest only for 20 years. Who would buy that house? Good. I want to make sure you all can do that. It's important to be able to say yes when it's the right deal, okay? If you're not quite to that point yet, you need to work up to this. That'd be a tremendous deal. Now, how far below market is 5% right now? 1%? 2% maybe. Those deals still could be made, but here's my point. The point of the story is what? Anybody remember? Purchase money mortgage is the point of this story. If this is a purchase money mortgage, if you borrowed that $280,000, which would be a scary amount for a lot of people, but it's a purchase money mortgage, and you can't make the payments, what can you do? You can say, I'm sorry, I can't make the payments. I'll give you your house back. You know, it's in decent shape. And what can they do then? Nothing. They can accept the house, but they cannot sue you for that $280,000 because it's a purchase money mortgage, and there's no personal liability on a purchase money mortgage. Now, there are some exceptions. I mean, if you tear this house up, if you steal all the appliances, if there's fraud involved, then they can come after you. But I'm saying it was just a real deal, and you get in over your head, and you can't rent it for enough, and you can't make the payments, you can walk away. What does that allow you to do, working either by yourself or with investors? It allows you to take a chance, doesn't it? It allows you to go out and make deals that you normally wouldn't make with very, very high leverage, knowing that there is a downside risk here. That the amount that you can lose is limited, maybe in this case, to that $20,000 you put down. Okay? And if you had this 5% interest, you might even be making cash flow while you own this house. So there's very limited risk here if you understand what you're doing. So if purchase money mortgages are a new concept to you, study them and set as a goal to borrow some money on a purchase money mortgage. Yes, sir, Bill?
Why the 20-year term?
Well, I just made that up. That's not a real deal. But 20 years is probably long enough for you to make a profit. Okay? Now, some people, anybody ever sign a short-term balloon note besides me? Who has signed a shortest-term balloon note? Mine's 3. Anybody doing shorter than 3 years? No? 3? Does 3 years go by pretty fast? Well, the next 3 years go by pretty fast. You bet. The older you get, the faster they go by. And if you want them to really go by, sign a 3-year balloon note. They just zoom, just like that. Okay? So 20 years is an arbitrary number, but longer is better, isn't it? Longer is always better. And so when you're borrowing money, trying to avoid any kind of short-term deal, especially if you're investing with somebody else's money. Don't ever get into a 3-year or even a 5-year situation. It goes by too fast. In fact, if you invest with somebody else and they want their money back in 3 years or 5 years, they're not entitled to much of a profit, if any profit. Sometimes they don't even get all their money back because it's the wrong time to sell something. And 5 years from now could be the wrong time to sell something. And these are interest-only terms here. What's the disadvantage of borrowing money on interest only? You still owe the whole thing in 20 years, don't you? What's the advantage? You have a lot better cash flow. Now, where do you make most of your money in this business? If we in fact went out and bought this $350,000 house for $300,000, and let's just say it's on the water, can you still buy a waterfront house in Florida for $350,000? Sure you can. There's a lot of them out there. Okay, not everybody's neighborhood, but there's still a lot of them out there. If you did that, what would that house be worth in 20 years? Hopefully a lot more. That's the whole plan, right? A lot more. So most of your profit is going to be in what? It's going to be in the appreciation and the fact that you bought them below market and the fact that you've got good financing to start with so you'll have some cash flow. If you had an amortizing loan and you borrowed $280,000 on a 30-year loan, 20 years from now it would probably pay down about half, wouldn't it? So you would have some profit in there. but your cash flow, you're better off. The question is, you want your cash flow today, or do you want to give your cash flow to the bank? And I'd always rather have my cash flow personally. If I want to pay the bank down, if I want to pay this lender down, I could. Would you prepay a 5% 20-year loan? Probably not unless rates get a lot lower than 5%, right? So it gives you the advantage to renegotiating that deal to your advantage.
This was an example of an interest-only loan.
Yes.
Like, if you negotiate with the owner, just instead of giving you the cash and sitting it in the bank, I'll pay you 5% on your money. That's what some people do.
Yeah, and I work backwards into that 5% rate. How did I get to that 5% rate? I asked the question, how much do you afford to pay this person and have it break even? Now, if you went down to a bank and borrowed money at 7%, that still might be a decent investment for you, but you would have negative cash flow for the first several years until you could raise your rents to the level where you could pay that 7% loan back. Okay? They'll always work backwards. Before you make an offer to somebody, an offer to pay them a lot of money, an offer them to owe them a lot of money, ask the question, how much income will this property really generate? And you might remember, I started with gross rents, and I came down to net rents. I just didn't say how much gross rent. Well, I said how much taxes, insurance, maintenance. I took something off for all that. I want to make sure I have enough cash in my hand to make a payment each month. Because if I don't have that cash, I could lose the property.
Would you pay down the debt as you go? If your rent is 5 years from now into the deal?
The question is, would I pay down the debt if I go? Probably not, if the interest rate was that good, not on a 5% loan. If I have a loan, and we'll talk about paying some loans off here later today. If I have a bad loan, if I buy a property, and what's the highest interest rate out there today, you think? If I went out and started, anybody find a house for sale and somebody had a bad loan on it, what was the highest interest rate you've seen in the last couple months? 12%? 12%? Yeah, there's people out there paying 12%. There's actually people borrowing at higher than 12% yet, because I know some of them. But it's interesting that if you have bad credit, what kind of interest rate you get? It's higher, isn't it? So if you've got a bankruptcy or foreclosure and you want to buy a house, will somebody loan you money? Sure they will, but it's not going to be at a great rate, is it? It's going to be a low rate. Benefit of investing with others here on page 4. It allows you to buy property when you otherwise couldn't. And that means when you don't have the down payment, but also it could mean something else. If credit gets really tight, does that mean all the rich people are going to be poor? No. Will there still be money around when credit is tight? There's still going to be about the same amount of money around. It's just harder to get. If you have access to people who will loan you down payments, you'll be able to buy property when other people who rely on bank loans, traditional financing, won't be able to buy. So a lot of your competition is going to disappear. And I won't say, I don't know how much, but there are a lot of people that buy real estate, and they only buy real estate one way. They go down to the bank and borrow the money when they buy the real estate. If you know other ways to buy, you'll be able to buy when they can't. What else could happen to you? It says here you can buy properties at bigger discounts with cash flow today. And that, I'm giving you some examples here. It's important that when you buy something, and one benefit of buying with an investor is if you put more money down and get a better interest rate on the financing, you'll have cash flow from the first day. It allows you to buy a property that other people can't buy and have cash flow. If you bought a $350,000 house, and I'm going to stop using this example because it's a bigger house than most of you need to buy. But if you did buy that house with a down payment, is it possible to have cash flow from day one? Yeah, if you put enough down and got a good enough interest rate, you could make $200 or $300 a month from the first day on that house if you put enough down. Now that's not a deal you would make, and it's probably not a good deal for you. If you're starting off with just a little bit of cash to work with, you wouldn't buy that house for your first house because it ties up too much money in one spot. Does a lot of things wrong. But if you have access to other money, it may be a good deal for them. And a deal with more capital gain potential, we've already mentioned that. First of all, you can have a built-in capital gain by buying something below the market. And the second side of that is it allows you to buy better property. If you're starting absolutely tapped out and you have no money, you're limited in what you can buy. And you tend to buy lower-end properties that have cash flow. Okay? And that's okay. That's a good place to get started, but pretty soon you'll have a lot more work than you want to do. If you can put together deals with investor money, it allows you to buy better properties to start with. And you can still have cash flow on those better properties. Let's just take a little higher price house to put this in perspective for you. Most of the houses I buy for long-term rental are worth someplace around $150,000. Okay? If I buy that house for nothing down, what kind of cash flow will I have? Depends on the interest rate again, doesn't it? If I buy it for nothing down and can finance it at 6%, still going to be negative cash flow, isn't it? So it's going to be hard to make that deal work for nothing down. But if I can get an investor in, and the investor puts down $25,000 cash, what's the first thing I should be able to do with that $25,000 cash?
Price down.
Bring the price down. Okay? And I've always used a rule of thumb that you should drive the price down at least $1 for every dollar you put down. So if we did that, if we drove it down $1 for each dollar of the down payment, how much would we pay for that house? $125,000. And we put $25,000 down, how much will we owe on that house? $100,000. If we finance that $100,000, even at market interest rates today, will we have cash flow? Everybody go like this or say yes. Yes, we'd have cash flow. We'd have positive cash flow from the first day on that house, wouldn't we? So here's the choice you're making. The choice I'm making every day is, do I buy this house by myself with a very low down payment and have marginal cash flow or no cash flow at all or even negative cash flow? Or do I bring somebody else in, okay, and use their $25,000 to do two things? And you have to do both to make this a good deal. Drive down the price and make sure we get really good financing on the balance. Because if I do my job right and I drive down the price and get good financing on the balance, the payments on this $100,000 loan could be $666 a month. Well, a $150,000 house rents for $1,200 a month, doesn't it? You've got cash flow from day one. And that's probably, for a simple example, would be a good one for you to focus on. Because that's basically what you should be shooting for if you're buying that price range house, a house that will have cash flow from day one. I've talked to a lot of different folks, good friends of mine, who've been doing this for almost as long as I have, and I've asked them, because many of these people have invested with others, and I said, what's the biggest mistake you've made? The biggest mistake everybody said they made dealing with investors is putting people into a deal where they had to call them up after the deal and ask for more money. So if there's one thing you never want to do, is because you look dumb then, don't you? I mean, when you put the deal together, you look pretty smart, but if you have to call them up 6 months later or a year later and say, we need more money, now you look like you're losing money. So it's a function of what kind of deal do you put together going in, and if you put together a good deal going in, drive the price down, get good financing, then you'll never have to make that call. All your calls will be happy calls. It'll say, where do we send a check? See, that's a happy call to make.
Around that 25,000, where does that come in as far as the interest?
I'll deal with that. The question is, how do we treat that $25,000 down payment? I will deal with that as we go through the class.
You're saying for every dollar that you put in for tax, you should be able to take that off the top of
Yes,
your
ma'am.
asking price?
Yes, ma'am. The question is, for every dollar we put down, should you be able to drive the price down $1? And the answer is yes. So if you put $10,000 down, you should buy at least $10,000 below the market.
But if you had, does that apply if you're doing a tax exchange?
It applies anytime you buy real estate. Because if you work backwards into this, if you ask the question, okay, that means if I'm buying a $150,000 house for all cash, how much should I pay? What's the answer? $75,000. If you pay all cash, what kind of purchase are you making, or should you be making if you're really in this business? You're probably buying at a foreclosure sale. Okay? And if you buy at foreclosure sales, you can buy it 50 cents on the dollar. Now, it may not be very pretty. Whatever you're buying may be a challenge once you buy it, but you can buy very, very cheap at that level. Now, you shouldn't buy there very often, because when you buy at a foreclosure sale, you don't ever get to renegotiate.
But if you're doing
It's
a
over.
tax exchange, you're not buying it, you're not having to buy it at foreclosure.
Well, you are, but what you're doing, if you're doing a tax-free exchange, you're still writing a check to somebody to buy their house, aren't they?
Right.
So when you give somebody, if you give me $50,000, you should get something for that, other than just real estate, because you're in the business. You should get a good deal. Now, if you want to pay retail, call me. My number is right in the front of that book. I will put together a deal for you any day of the week.
$100,000 to put down, you're not going to ask them to take $100,000.
Yes, I am.
off the top.
Yes, I am. Write this part down, because you don't quite have it yet. If I give somebody $100,000 down, I'm going to try to buy $100,000 below the market. Okay? I rarely give somebody $100,000 down. But the last house we bought a foreclosure down in Venice. It was worth about $200. We bought it for 80 something. It was really worth about 175. We bought it for 80 something. What's the ratio? It's about half, isn't it? It's about half. This house needed work. Some of you heard me tell the story about this work. Brian can tell you about this house. Somebody had gone through this house with an axe and chopped a hole in every piece of drywall in the whole house. Plus, they took out the mirrors, the doors, the windows, and the pool. So the guy, they were mad. they left mad. And this is a situation where the lender just wouldn't talk to the owner. The owner wanted to bring the payments current. The owner wanted to keep this house, and the lender said, no, we're foreclosing. Too late. Wouldn't that make you mad? You bet it'd make you mad. And these people got mad. I wasn't mad at the people. I never met them, actually. But I can see why they got mad. And so we bought that house really, really cheap. Why? Because the lender was scared of that house, weren't they?
It sounds
Well, there were several other people who wanted that house, but we got there first and we bought it. Because when you buy at that kind of discount, you do have some competition. How long can you think about that house? Not long. We bought it and closed within a day or two. Okay, you have to do that very, very fast because with that kind of discount, there's competition. Anybody hear my competition to that kind of deal? About half the room's my competition. Okay, that's why I'm not going to tell you about the next one we're buying. Okay? I'll tell you in the next class, not today's class. Okay, so but you can buy below the market. You have to be a pro. I mean, you have to make these decisions. If you buy with $10,000 or $20,000 down, now you're making a whole different level of deal, right? You're not buying 50 cents on the dollar, but you should get this discount. If you just buy with $10,000 down and pay retail to get your $10,000 back in a hurry, you're going to take a loss because you probably can't sell retail. See? So you have to buy enough below retail so you can get your money back. And this is especially important if you're dealing with investor money because sometimes you need to get the money back. I mean, you don't ever plan on that, but if you have to get the money back, and I'll talk about this as we go through it, but if you put up $100,000 today, and I buy a house, and we own this house together, and you call me up next week and say, John, I've got to have my $100,000 back, what kind of situation am I in? What am I going to do? Where am I going to get the $100,000 to give to you? Probably not. What I'll probably do is I'll call somebody else I know who has $100,000 and say, I've got a good deal, would you like to buy out their position? But it has to be what? A good deal. If I'd paid retail, I can't call Steve up and say, give me $100,000 and we get into this house. He said, why? It's retail price. I said, yeah, I don't have a good answer why. But it was a $350,000 house we bought for $250,000. Now I can call Steve up. He'll probably, if he has to sell a couple cars, he'll bring the money over. Okay, we'll get the money. So if you make the good deal going in, then you can replace that money. But that's a key part. Yeah, Bill.
But you don't go in unless you got a good deal.
You've got that right. Write that down. You don't go in unless you have a good deal.
So far you've had two money.
I like it to be. I would like it to be. If I borrow $100,000 from somebody, I would love that to be an interest-only deal. And I'll explain that as we go through. Most investors who give me $100,000 would rather have me pay them interest only for a couple simple reasons. Number one, then we always know how much I owe them. It's always $100,000. And number two, if they're charging me a decent interest rate, let's say I'm paying 10% for it, they'd rather keep the full $100,000 invested at 10% than have me pay them back $80 of their principal each month, which now is going to go where? It's going to go in a checking account and earn nothing, or in a savings account and earn 3%. So investors want to keep all that money invested, and that's why we're looking for somebody who understands that, who would like to keep the full amount invested. Many times it's if I pay my investors back. If you give me $100,000 and I start making you payments, you might be spending the payments. You know, you might be using them for food or something else, but you don't want to spend your principal. So it's good for many reasons from the investor standpoint to keep the full amount invested. From my standpoint, it's always better because it keeps my cash flow better. I'm not paying that principal, which is good for me. Okay. Now we say number 3 here on page 4. It allows you to borrow to invest with less leverage and less risk. And I think I've covered that. You know, by using somebody else's cash, you can buy things further below the market, but still you're not using much leverage because you're using their cash for the down payment, and you're getting better than retail interest rates. And down at the bottom here, we talk about matching needs and benefits. Things that you have to offer, and there's not a particular order here, but I think a couple things at the top are real important. The first thing you have to offer probably is your reputation. If you know what you're doing, and the word is on the street that you know what you're doing, you know how to put a deal together, and you can tell people that, but how do you really prove it to somebody? You show them a deal. You go to them with a contract and say, I have this contract to buy this $150,000 house for $120,000 with $20,000 down, and they'll carry the balance at 6% for 30 years. If you really have that contract and it's signed, and you have 10 days to inspect the house, you probably don't want to say 10 days to raise the money. You want to probably say 10 days to inspect the house. You have some clause in there that allows you to get out of this contract. Then you have 10 days to find somebody to give you that $20,000 to buy that house. And if you really bought something below the market and you really made good deal on the financing, you'll find that $20,000. That money is out there. There is no shortage of money for good deals, but you have to have a good deal. I mean, the two things do go together. So your reputation is important. How long you've been in the business, how well you've managed property in the past, and certainly if you can take people out in your car and show them deals that you've done and talk to them about the deals, and they're under management and they look good and the people who live there look good, it's not nearly as scary for folks. One reason I like the houses for an investment is most people are pretty comfortable with the house, and we'll talk about that in a second, but a house is not nearly as scary as buying this motel, right? If you bought this motel, although it seems to be in the right part of the world and looks pretty decent, you still don't know if you're going to make any money. The mechanics of making money on a house are a lot simpler. You collect a rent once a month, you put it in the bank. You don't have to worry about occupancy rates, you don't have to worry about employees or all the things that go wrong. So it makes a pretty good vehicle for investing in. The time you've got, most people you invest with either are lazy, which means they have a lot of money in the bank and they won't go out and work very hard anymore, or they're doing something else. You know, maybe doctors or lawyers types where they're working 80 or 90 hours a week and are making good money, but they don't have an extra 20 hours a week to go out and find a good deal. So either one of those makes sense. Your experience, your ability to buy wholesale, and I've stressed that so far this morning, and to recognize a good deal, to negotiate a good deal, to close on that good deal. And those are skills I won't teach you in this class, but those are skills you need to develop. And I do teach them in other classes, so if you don't have those skills, come get them. The ability to manage, and manage well. And because the difference between managing well and managing poorly is a big difference when it comes to cash flow. What's one sign that you're managing well? What's one sign, you folks that are in a single-family landlord business, what's one sign that your management program is healthy? People stay with you. Your tenants stay with you. You don't have a lot of turnover, and you're doing what at the same time? You're raising your rents. Okay, if you never raise your rents, I rode on an airplane once, and I was sitting next to this lady from Fort Myers. She was an apartment complex manager, and we were talking about how long people stayed. She said, I've had all my people 20 years. I said, really? I was embarrassed. I was talking about 6 or 7 years, which I thought was a great deal. I said, how do you keep them for 20 years? She said, it's simple. I haven't raised anybody's rent in 20 years. Well, if you've been living in the same apartment for 20 years and they haven't raised the rent, you probably wouldn't move either till they carried you out of there, right? So, I mean, that's one strategy, but that's not a healthy program, because maybe the manager's got an easy job, but who's not making any money? The owner. If you haven't raised the rent in 20 years, they're giving away who knows how much money on a monthly basis. So if you're raising your rents on a regular basis, and you're maybe not at full retail, but you're close to it, and you're keeping your people, then you're doing something right, because your costs will be a lot lower. So you should be able to tell that story to folks. Ability to sell at the right place and the right time. Most people don't know how to buy or sell real estate. If you know how to do that, you have a rare skill. If you know how to negotiate a good price and a good terms, you have a rare skill. Very few people have that ability. And if you have that ability, you're worth a lot of money to your investors. And ability to structure a deal to reduce or avoid taxes. I'm going to show you a couple different ways to structure deals here where you can get the income to your investors at a lower tax rate. And that's a major benefit to people, and most folks don't think through that. And a better deal with than your competitors. Who's the major competitor if you're trying to raise money to invest in real estate? Anybody selling limited partnerships, real estate limited partnerships, or REITs in your town? How do those guys get paid? You ever study how that works? Do they ever get paid, the guys that put those deals together? Do the people that ever invest in those deals ever make any money? Rarely is the answer. Here's how they get paid. When a syndicator just comes up with this brilliant idea and says, we're going to raise $10 million, how does he raise that $10 million? He sells something, right? So who sells them? Some salesperson. And does that salesperson get paid? Sure. So out of that $10 million, probably, I'm just going to round figure this off, but probably $2 million disappears right off the top to put this whole deal together, all the lawyers, the marketing, and all that stuff. So now we've got $8 million left to invest. And they go out and buy something, right? What do they buy for that $8 million? Something big. They buy an $8 million building. They might even buy a $7 million building and pay $8 million. Why would they do that? There's a lot of pressure to do something. You got $8 million in the bank, you don't look very smart, do you? And syndicators pay too much on a regular basis. They pay too much because they're dying to buy something. Because when's the next time they get paid? When they buy something, they get a commission. Somebody got a commission when that thing got paid, bought, didn't they? What's the commission on $7 million? Pretty good. Okay, let's just take that out of the deal. Now we're down to about 6.3 left actually going to work, right? Okay, and they take that money, and now they own this building. Who manages this building? For free? No, somebody gets paid a management commission, right? The whole time they own it. And then what happens when we sell this building? Pay a commission. Pay a commission. I hope they sold it for more than they paid for it. They don't always. Okay, they often structure the thing as tax shelter deals. And then what happens to the net profits here? Let's say at the end of all this whole deal we have $8 million left over. Who gets that money? The investors get part of it, and the syndicator gets part of it. It's not unusual at all for the syndicator to take a percentage, maybe as much as 25 or 50% of that into profits. So how'd you do so far? You want to invest in this? How many people want to invest in this deal at lunch? It's a lousy deal. But people invest in those deals all the time. Why do they do that? Why do folks write checks for $50,000 and $100,000 to invest in a limited partnership, real estate limited partnership? It's easy. It's easy. It's easy to write a check for $100,000. You never have to meet a tenant. You never have to buy anything. Can't you give somebody a better deal than that? You can give somebody a remarkably better deal than that, and a safer deal. And anybody ever heard of somebody trying to sell their partnership interest before the deal cashed out? How much are they worth? If you have one share in some big building, there's 500 shares out there, how much is your share worth? Not much, okay? And I've often thought that would be a good business, just forming a capital pool and buying up limited partnership interests, generally in a depression, because you can buy them for pennies on the dollar because they are worthless to people. And until that property gets sold 10 or 20 years down the road, nobody gets paid anything. So I'm not sure that's a good strategy, probably not. What the investor has to offer on a stage. What's the first thing an investor has to offer? Money, okay? Second thing I say here is credit. I've had investors many times go to the bank and borrow money to buy something. I've said, and it's true earlier today, that I've never gone to the bank to borrow money to buy a house. I just won't do it. It takes too long to start with. But I've had investors do it. I've had investors go down and qualify for loans, assume loans, all sorts of stuff, because investors will do things I won't do. Sort of like that old lawyer joke, you know. But a lot of people don't mind going down to the bank and borrowing money. I do. But if you want to be my investor, and we have, for example, I had a bunch of houses we bought from a builder one time, and the bank who had these loans said, we'll let you take them over, but we want somebody to sign the paperwork. And I said, okay, I'll find somebody. It wasn't me. I sent somebody else down to sign the paperwork, and then I bought the houses, and I let them keep part interest. And we'll talk about that as we go in. But banks are funny. If you go down to the bank, Bill, if I send you down and we have this house we want to buy, and you go down and you qualify for that loan, and the day after you qualify for the loan and we close it and you own 100% interest in that house, if you deed me 50% interest in that house, does the bank get excited?